Hi, everyone. Good afternoon. Hope you all are having a great Tuesday. We were all just chatting about how it already feels like a Thursday or Friday, but we're getting there, everybody. Thank you all for taking the time out of your day to join us. This session today is for Hands Asset Management Affinity Group. And today we're going to be discussing captive insurance and insurance captives. So we're super excited to have this session because it came directly out of a lot of feedback I've had with meetings with members, not only just in general about the state of the insurance market in the affordable housing space, but also what people are doing, why they're making these decisions to go with master versus captive, and kind of like the timeline that you all need to be thinking about these things, and how the pros and cons would benefit you all and your properties. So we're really excited to have Nate here to give us some background on the insurance market, as well as some information on captive insurance. We also have Ari here from TM Associates to tell us more about the for-profit perspective. And I know I've talked to a couple of you who are joining the call as members who have a nonprofit perspective. So just want to reiterate that these affinity groups are very conversational and informal. So if you have perspective to add, or if you have questions, please raise them. Now's the time to collaborate. Let us know of any problems you're running into. There are other people on the call who are probably experiencing the same things. Typically, if one of you is having a problem in this industry, you're not alone. So just want to reiterate to ask your questions, raise your concerns. This is a time that we can all collaborate and come together on solutions around any problems we're having. Or if you're having really good success with something, we want to hear about that too. It doesn't always have to be about the challenges in here, but if you have something that's working really well for your organization, whether it's on this topic or not, we'll have time for that at the end. But again, please feel free to be open and sharing. Tiana, can you go to the next slide, please? We do want to set some ground rules for today's session. On that note, we ask that you do have your cameras on so that we can participate. We'll do a quick icebreaker in a minute to get you guys participating and ready to be a part of this discussion. But with that, want to remind you all to be respectful. Like I said, if we're talking about challenges or issues we're running in, this is a safe space. Be constructive in your feedback to one another, and that goes with full engagement as well. Try to have your cameras off, put a face to a name. It's really nice to connect in these virtual environments as best we can. So keeping that in mind, I do want to get us all chatting so that you can stop hearing from me. We'll go into a quick icebreaker with everyone. I had you guys dropping your names in your chats, names and your organizations in the chat, but want to get you all talking. Nate has a really good presentation prepared for you all, but we do want to get a sense of who in this room is already part of a captive. If you're not, what is it that your organization is doing? And then what is it that you hope to take from today's session? Or do you have a specific question that made you sign up for this session? What is it you want to get out of today? So if you want to go ahead, I'll drop these questions in the chat, but we're going to bring down the slide so we can see everyone's face come off, and I can popcorn it around to some people. I'll type it in the chat so we have it. All right, Tiana, if you can just bring down the slide so we can see everybody's faces. All right, everybody. HAND is a nonprofit membership association, so we do not have an insurance captive. I'm really excited to learn about this because a lot of people have brought this to my attention, so I am not the expert. That's why we have Nate here, so I'm super excited to learn about all things captive insurance. I will popcorn it over to Brendan because I noticed you've had your camera on. Can you introduce yourself and let us know in 1 to 2 sentences what it is you hope to get from today's session?
Sure. I'm Brendan Dolan with Housing Partnership Network. My duty at HPN is overseeing our insurance captive company, Hypex Insurance, which includes 23 member organizations with about 100,000 units across the country.
Awesome. Thank you. Hey, John, you want to go next?
You're on mute.
John Spencer. Yeah. Hi, I'm John Spencer. I'm executive director of a small nonprofit in Northern Virginia. We have 5 senior properties with 800 units. We had the unpleasant experience last year at the 30 days to go with our insurance renewal being dropped for our master policy, and we had to scramble for all of our properties. So I'm just kind of interested in this concept. I don't really know anything about it. Perhaps it's a solution for us going forward in the future.
Thank you. Going in order on my screen, Angie, would you like to share?
Hi, Angie DeMorla, Director of Executive Operations at the ARC Central Chesapeake region. I have to admit, I have no idea what captive insurance is and how it would benefit the ARC. Our CEO was interested in learning more and wasn't able to make the meeting, so we're here to how this would work for the ARC.
Awesome. Thank you. I'm on the same page then, all starting from scratch. Daniel, can you go next, please?
There I am. Hi, I'm Daniel. I'm actually the president of Fellowship Square Foundation. We have 4 apartment buildings, 2 in Reston, 1 in Maryland, and 1 in down south near Woodbridge. Christy asked me to be here because she's on vacation. And I'm actually, my profession, my full-time job, because this is a volunteer position, is a certified risk manager, so I sort of know a lot about this subject matter. So she wanted me to sit on this and give her the feedback.
Thanks, Daniel.
Huh?
Judy?
Hi, I'm Judy Olinger. I'm Executive Director of Chesapeake Neighbors, and I am a complete novice, know very little about this, so I'm really just here to learn at this point. Yeah.
Awesome. Thanks for joining. Our nonprofit perspective. Dee Dee, are you able to go next?
I'm sorry, didn't hear you say Dee Dee. Yes, hi everyone, Dee Dee George here. We are members of the captive and work with Brendan, and we love it. It's just in the face of astronomical increases, we feel like this is the best place to be in terms of for our needs, in terms of having insurance coverage. So excited to be part of this and learn from everyone else. But I'm with Wesley Housing.
Awesome. Thank you, Dee Dee. Jeff?
Okay. Hi, everyone. Jeff Mosley with Capital Impact Partners, part of Momentous Capital brand of families. Most like everybody else, sort of looking to learn from this webinar from 2 perspectives. One, looking at sort of the deals our developers we support, diverse developers as they sort of pursue their projects and grow their enterprises, and looking at the impact of insurance on their projects, their capital stack, but also from internally and looking from a risk management standpoint about the impact of insurance on portfolios. So happy to be here.
Thank you, Jeff. Jesus?
Good afternoon, everyone. I'm Jesus Esquivel. I'm the Director of Asset Management / Risk Manager for Arlington Partnership for Affordable Housing, also known as APA. And I've been with APA for 2 years, and I've been running their asset management department, but also acting as their risk manager. And I've been assessing our options within APA to find out what the best setup would be, whether it would be our own captive program or being part of a bigger one. So I'm interested in learning to see what others are doing and kind of help me assess my options.
Great. Thank you. Denise?
Hey, good afternoon. This is Denise Aluo. I'm with Merchants Capital, GSE Chief Underwriter here for Fannie Mae and Freddie Mac, so on the lender side. And we're seeing a lot more property owners with captive insurance, so I'm also here to learn more.
Thank you. I think up next we have Alexander. Not sure if he's on. Sam, are you available to go next?
Hi, yes, I'm Sam Paul. I'm the Director of Administration with the Howard County Housing Commission. We are the public housing authority for Howard County, Maryland. And we own a portfolio of approximately 2,500 units in the county, a very broad mix of market rates, low-income housing, tax credit financed, HUD financed, and et cetera. And I'm on because as a lot of multifamily and rental property owners, property insurance especially is becoming just a very burdensome cost. So hoping to learn more about captive insurance and how it can help us.
Thank you. Hope?
Yes, so I'm Hope Rudder. I'm from Virginia Housing. I'm the Director of Rental Servicing. As you can imagine, insurance, just like everybody else, is a huge impact on our portfolio. And we do set the requirements for our portfolio. So this is my first experience with captive insurance. I'm really just looking to learn more.
Awesome. Thank you so much. No worries, Alexander. I saw your note in the chat, having some technical difficulties, but excited to be here and listen. We are happy to have you. Last but not least, Beverly and Ari are here from TM. They're going to be chatting a little bit more later, but want to give them a chance to introduce themselves. I know you're both part of the same captive, so go ahead.
I'm Beverly Hanlon. I'm the Director of Asset Management at TM Associates. Didn't know anything about captives when I got to TM, so I'm kind of learning. Ari is definitely the expert, but we participate in Rural Housing Reinsurance Group out of Bermuda, which is one of the oldest captives in the well, I guess it's not in the United States, but Ari can tell you exactly more in terms of like how many units participate in the captive.
Awesome. Thanks,
Hi,
Bev.
I'm Ari Sabir, president of TM Associates. Yeah, we were one of the original members of Rural Housing Reinsurance out of Bermuda back in the 80s. It has expanded quite a few times over the years. Like Brendan's group, we now have quite a few members. Yeah, our group insures well over 100,000 units. And so there's a lot of like-minded developers who are part of our group and more who are asking to join every day because of this, it hasn't always been like this. There's been times in the past where it's also been hard markets, and that's when we tend to grow. But, we also always mindful of who joins our groups and what they bring to the table risks wise and everything else. And, it greatly influences our decisions on our own portfolios and anyone else who wishes to join our group.
Awesome. Thanks so much. And we'll have time to hear more from Ari a little bit later. But again, I just want to thank you all for coming. Keep the questions coming. I know this is new to a lot of you all, so now's the chance to ask Nate while we have the expert with us as a group. But with that, I want to pass it over to Nate with Captive Insure. He's got a great presentation for all of us folks who are just learning about this. So without further ado, take it away, Nate.
Thank you, ma'am. Hey, two quick questions. One, Can you hear me? And then two, when do you want me to stop talking?
You have the floor until 1.
Until
so
1.
As long as you
Okay. Thank you very much. So pleasure to chat with everybody today. If at any point in time I say something that doesn't make sense or you do have some questions, post it in the chat, unmute yourself, interrupt me. You're not going to hurt my feelings at all. I'm the president and owner of a company called Captives Insure. We are a captive consulting agency and an underwriting firm. Our company gets hired by brokers, insureds, regulators, and insurance carriers that are trying to figure out how to get into the captive insurance space. I myself teach for the International Center of Captive Insurance Education, started up in partnership and collaboration with the University of Vermont. So for the folks that maybe have never heard the word captive today, we'll at least get you familiar with some of the concepts. If we do happen to have any offhanded questions for those of you that are more experienced, I'm likely to be able to go ahead and address whatever questions or challenges you may be experiencing now and provide a little bit of feedback as well. So with that being said, I would like to go ahead and let's dive into a presentation here. I'm not going to go ahead and read the slides off to you, but I'm going to use them as a guide as we kind of talk our way through the concept. If we go to the very first slide. Perfect. So let's just talk about things that's not going to be new to you. One is the purchase of traditional insurance is a sunk cost for business owners and folks either in the affordable or market rate space for habitational risks or trucking companies or medical providers. It's all the same. You're paying in premiums for coverage that you're getting from some third party. Whoever that insurance company is going to be retaining all of that risk. And in the instance where you have maybe good years or bad, good years, you're not going to be getting returns of that premium through a traditional insurance placement. You don't have a lot of choice. You have very few tools in which you can deploy in order to kind of manipulate and control your premium spend. If we move to the next slide, I can kind of tell you a little bit more about why we're seeing some of the poor results that we see inside of the insurance market. Largely, it's because you don't have the ability as a standard insurance purchaser to choose who you're sharing risk with. So an insurance company, when you pull back the curtains, looks very, very different and there's a lot of very different moving parts than your normal operating entities. There are some key concepts and rules and regulations that go along with insurance that maybe you would be unfamiliar with as a normal insurance buyer. And one of those things is the concept of risk distribution or risk sharing. If we think about it from a personal lines insurance perspective, it becomes, in my opinion, pretty clear to understand. So I luckily have never had my home burned down. Knock on wood, it doesn't happen. But I've been paying my insurance company now for who knows how many years, premiums. In the event that my house does burn down, somebody's going to go ahead and pay for my claim. Okay. I know that my premium dollars are being used to rebuild structures for individuals that did have their homes burned down throughout the past year. Okay. They know when they purchase their policy that, or they should know that their premiums are going to be used for the same and that event happens to me. So we're sharing risk in that scenario. What that ends up can end up happening is we can have large, sometimes global natural catastrophe events that can impact your premium pricing. So the wildfires in Australia that happened a couple of years are a really good example of that. It's a very low likelihood that any of you had a portfolio in Australia that would have been affected by those wildfires. But that fire impacted the reinsurance market, which was then justifiably or not utilized as a justification for increasing premiums for property coverages throughout the world for the next about year or 2 years. Okay. Insurance companies will also, they love businesses that run really well, that have low losses compared to the premiums that they're receiving, because they're using that difference to essentially purchase the insurance coverage or provide the capacity and risk for the businesses that don't manage their operations as well as the good folks do. Insurance companies, by and large, do not make their money on the difference between the premiums they take in and the claims they pay out. Large insurance carriers actually make their money on the timing of those claims and the investment dollars they're able to earn while they hold those premiums in place. Okay. It's not a commonly known fact to many, but the insurance market in and of itself typically operates on about 100% combined ratio, which means, again, all of those premiums, the income I'm receiving, I'm going to be expected to at some point in time pay all of that money back out in claims. That may not look like your individual performance from as an insured inside of the standard insurance market. So what ends up happening is that businesses are trying to find a way to get outside of that rat race, get off the roller coaster. And unfortunately, the only way that you can do is you can't beat them, join them. And the join them portion is where captive insurance companies come in. So if we want to advance to 2 slides for me, I can tell us what a captive insurance company is. Good news, it is nothing complex. Okay? A captive insurance company just as a general definition is a privately owned insurance company. There are different flavors and sizes and names that things can be called, but the concept remains the same. I either own, either myself wholly or as a share of stock, something that is a larger insurance company. Because I own it, I then have rights to the underwriting profit or assets of that insurance company. So now I'm sitting in the position where if I am receiving in premiums for taking on risks and I do not have any claims, I get to retain that underwriting profit. I get to retain the investment income that may have been generated off of that underwriting profit. And in that scenario, then you're now sitting in the same position that insurance carriers are, except you're one of the good risks, right? So your premiums should be larger than the claims expense that you've had in the past. So historically, that money that was getting set in the corner of the room and getting lit on fire to be used to pay for the poor risk selection of the other performers in the market, you're able to redirect that to your own insurance company and retain those dollars. I'm going to pause there for just a second and just make sure I don't see any questions in the chat, or if anybody has any, I can address them now. Okay, good. I'll keep going. And again, interrupt me if I say something that you do want me to touch on a little bit further. So captives in the States are nothing new. They've been happening since the 1950s and used by almost all Fortune 500 companies that are in the US. If we go on to the next slide for me, captives are also being used in almost every kind of market that you can imagine. Apologies because we got a little formatting issue here with my chart. But what's ended up happening is that the best risks are leaving the market. We're getting something that's called adverse selection. So that pool of risk of individuals that you are all sharing risk with in the standard market is getting smaller and smaller because the individual companies that have good loss ratios are taking their risk out of that pool, forming their own insurance companies or joining existing captive insurance companies where they get the opportunity to retain that underwriting profit. Real estate is about the middle of the pack. This study is the 15th study done by the Captive Insurance Companies Association. I believe the data is maybe about 3 years old at this point in time, but it is the largest set of data that we have. If we move to the next slide, we can see where captives are being formed. So captive insurance companies are licensed and regulated entities. That means that you get to essentially select which domicile or regulator you'd like this new corporation to be overseen by. There's about 7,000 captives in the world today, with the majority of them being either in the United States or in the US Virgin Islands or British Virgin Islands. There's a smaller captive market over in Europe and a growing one that's in the ASEAN or the Southeast Asian region. But by and large, folks are going to be putting their captive insurance companies in the USVI or BVI. So think Cayman or Bermuda, St. Croix historically, or they're doing it in the United States. The reason that we see those two formations being so large is due to timing. So that historically, when captives first came around, there was not a lot of ability inside of state statute that would allow for captive insurance companies to be formed. That law existed in primarily Cayman and Bahamas, or Bermuda, where those three entities are kind of what started it out. So naturally, that's where most captive formations started to occur. Inside of the US, insurance is regulated at a state level and not a federal level. So what ends up happening is individual states started passing captive statute to allow for privately owned insurance companies to be formed in those states. So Vermont, Tennessee, Utah, North Carolina, Georgia. As of right now, there's about 36 or 38 states inside of the US that have captive statute on the books. So what we've seen is a large influx of redomestications is what it's called, for folks that may have had their captives offshore at one point in time because that was the only option, to having them either moved back onshore or being formed onshore from the get-go because there's more options. And rightly or wrongly, the shareholders of an insurance company, for whatever reason, a lot of it is optics related, simply don't want to have their insurance company be set inside of an island jurisdiction. Everybody just thinks Tom Cruise, risky business, right? Running around with a briefcase full of money. It's not the case, but you can't get over that public perception all the time. We move to the next slide for us. I want to touch on just a couple of things that are quickly important, and that is just because we have an insurance company, a captive insurance company, doesn't mean that we have the ability to write insurance policies that for whatever we want. We're going to be limited kind of twofold. The first is from what's called an insurable interest perspective. That just means you've got to have some skin in the game so that if I formed my own captive insurance company today, or I joined a group captive tomorrow, I couldn't extend insurance to my business neighbor across the street, or a unaffiliated member couldn't join my group captive. We have to have some type of connection where if a loss occurs somewhere, that there is the ability for my captive insurance company, that loss to also impact me. The other is, and I'll pick on them quite a few times today, and that is banks. So lenders, vendors, interested third parties, Fannie, Freddie, HUD, they also will give us direction and requirements inside of the insurance covenants of our contracts that say, if we're going to allow for you to do X, we need you to show that you have proof of insurance. And that proof of insurance for your properties will tell you it needs to be coming from insurance companies that have a certain size. We don't want you to be taking deductibles or self-insured retentions over a certain dollar amount. Historically, insureds would look to maybe limit coverage language to help control some policy premiums. Now those contracts will say, well, you have to have these certain things covered inside of it, right? Your captive insurance company is likely never going to have the rating necessary in order to satisfy those lender requirements. That rating is an AM Best rating. Think of it as a FICO score for insurance companies. It'll tell you how strong, how financially stable that insurance company is. In order to have a rating of A or A minus, which is where we typically see the minimum thresholds for acceptability for lenders come into play, your captive insurance company would have to have tens, sometimes hundreds of millions of dollars of assets inside of the insurance company. Okay. So we'll get into this here in just a little bit. But in this instance, your captive insurance company still participates inside of these arrangements, but they do so as a reinsurer, where we engage the services of a company that does have that rating, that does have the paper essentially that'll satisfy all those lender requirements, premiums paid to that entity, which is then ceded back to the captive insurance entity, whether it be one that you all wholly own individually or a group entity that'll be, again, shared by all of the members that may have purchased stock inside of that group.
Hey,
All right, so
Nate.
unmute yourself. You want to make a comment?
Yeah. Can you talk to people about the importance of things like the AM Best rating and what's admitted versus not admitted, and how that affects you when choosing a insurance partner with your captive?
Yeah, I can do so. Again, largely this is going to boil down to the contract, the covenants inside of your insurance requirements for between your lender and your operating entity. That lender is going to dictate those terms back to you and say, this is what we want to see. Again, the AM Best rating is what says how financially strong that insurance company is going to be. The higher the rating, the highest possible is A+ from AM Best. Then there's a financial strength size that goes up in numbers from like 8 to 15. So 15 is the highest. So the individual lending entity makes the credit decision that says, I'll be comfortable with knowing you have insurance from a company that has at least an AM or A-9 financial strength of 10 rating. I'm just using these numbers as an example because that individual lender then has made the determination that if a claim comes through, the insurance company that's provided the coverage has enough money in order to go ahead and pay for the claim. It doesn't look like an insurance company that's in jeopardy of having a run on it from a claims perspective, or if they, again, they go to file, they have a loss, go to try and get the money back, restore, renovate that property, the carrier is out of the money, okay? That's where the admitted versus non-admitted comes in as well. Essentially what an admitted insurance company is, it's one that volunteers to participate in some type of state fund, along with every other admitted insurance company in that state. Now, my company is headquartered in the state of Tennessee, as an example. My reinsurance company is regulated by the Tennessee Department of Commerce and Insurance. My reinsurance company is not admitted. So what that means is if my reinsurance company were to go belly up, whoever is responsible for paying the claims is going to be me and my reinsurers. Under an admitted policy structure, if I were to fail, there's going to be another 24 other admitted insurance carriers in the state that have volunteered to step in and essentially pay for my losses. Admitted policies are generally viewed to be less risky, so they don't have what's called excess and surplus lines premium associated with it. They can be more expensive. The difference being, though, that because things are non-admitted, it gives us the ability to do some things with coverage language that you may not otherwise be able to do admitted. So there's pros and cons to both. I hope that helps. A little bit more difficult of a question than not one directly related to captive, but it's important because, again, what's going to be driving your decision beyond price and coverage language is what you're able to buy, because the lenders are going to dictate those terms back to you. Okay. Let's go to slide 11 for me.
Nate, just a quick question.
Sure.
Are the lenders going to be prescriptive about the type of firm, whether it's captive or not?
That's a very good question. And I'll address it now. So every insurance company on the planet that's of size utilizes reinsurance. Okay. So at some point in time, an insurance company, my own reinsurance company as an example, does the same thing. I make the determination of, you know what, that's enough risk for me. For whatever reason, I want to have somebody else pay for a loss that exceeds my threshold. So what happens is I take a portion of my premium, other insurance carriers take a portion of their premium, and they use to pay those third-party reinsurers. That reinsurance transaction is behind the scenes. So when I have a certificate of insurance that would be issued for your business, that's going to go to that lender, as an example, that bank to review, what they're going to see is the deductible and the policy that was issued on the paper I gave you. So it would be that A plus paper, okay? The fact that you have a captive insurance company behind the scenes that is reinsuring that A-rated carrier is nobody's business. It's invisible to the transaction, and it doesn't get reviewed in any of the vetting process or due diligence process by that bank underwriter. Does that make sense?
Yep. Yep.
So we've got a couple of different flavors and types of captives for me. Let's make sure I think we may be off a slide. I'm looking for one that says common captive policies. I think I may have skipped. Yeah, it looks like something happened with our formatting here, so apologies there. There's inside of a captive insurance company, again, it's a wholly owned entity. So we have some varying degrees of control over what we can or can't put into our captive insurance company just by its structure, which I'll touch on here in a second. But unsurprisingly, businesses have elected to take risk and form captives where their largest premium spends typically are. And those lines of coverage are going to be the things we'd expect: workers' compensation, general liability or auto coverage, property or builder's risk coverage, your marine cargo professional, or some life and health benefits like through medical stop loss, voluntary benefits for employers that have larger number of employers. Will do AFLAC style coverages back through the captive insurance company to essentially provide better offerings and employer retention offerings to their members of their staff. Underneath this, the next slide, please, we have different kind of flavors for captives. I've listed some of the common ones that we see here. So simply, and this will be important for you to take away today, is that if you hear the word captive, that doesn't really tell you anything more than somebody's got an insurance company where they have some ownership share in it, okay? There are, generally speaking, kind of two different categories of captives. There's one that's called a group captive, which is super easy to understand. And if you're likely to get exposed to the captive concept, this is going to be your likely point of exposure. A group captive company is just one where I buy a share of stock in something else that already exists. I now have a voting share of stock inside of this larger group. And I'll give some more detail here in just a second. But at the end of the year, or as some years pass, if I had premiums I paid in that were less than my claims, I get back a dividend and some investment income. So we're taking on some risk. I get a vote in the process, and then I get a dividend opportunity that comes back in the future. The other captives that we've got here are different versions of the same thing. And this is, it can be a frustrating thing to have happen, but for some reason, the insurance profession loves to give the same thing multiple names and make it as confusing as possible. Do not know why, okay? So again, under these assumptions, somebody's going to own the captive. Somebody's going to take risks. It's going to be privately owned. And in some instances, it may be an association where the members of an association get together and say, we're providing services that are outside of just buying insurance, sharing of best practices, whatever the case may be. And we also want to provide an insurance program to our members. Then the members of the association itself becomes the beneficiary, and it can distribute that underwriting profit however it sees fit. Then we have pure or single parent captives. And this is where an individual insured. So maybe I own a business or series of businesses, and I'm going to say I'd like to form a captive just to ensure my operations. I'm going to own the captive wholly. I get to control completely the board of directors, the officers that are associated with it, what lines of business, how much risk I want to take. I'm not sharing risk with anybody else, okay? But I am going to have to bear the cost of operation on my own, okay? So it may be a little bit more expensive to get into, that has a higher threshold or barrier for entry than a group captive does. And then the last of these three options are going to be some kind of cell arrangement. And cell arrangements I'll touch on here in just a little bit, different, are kind of a blend of the two, a blend of a group, a blend of a pure captive that's meant to bridge the gap between the two, provide a little bit more control and underwriting profit than you would get in a group captive arrangement traditionally, but not as much as you could get in the single parent arrangement, in the single parent structure. Let's go to the next slide for me. And I'm going to touch on group captives specific. So group captives most commonly will provide coverage for either benefits or casualty lines. And largely those are going to be your workers' compensation, your general liability, your auto type coverages. Some will do professional liability. Very few of them will do any type of property coverage. All of them are going to involve some level of sharing of risk. So it ends up happening is, remember that big, large pool of insureds I was telling you you're sharing your risk with now in the standard market. You don't get to choose who's good or who's not. Under the group arrangement, the group identifies a box that they say, this is what good looks like. These are the members that we would allow to enter into our group, and they can be segmented in one of two ways. Now, the terms are fancy, the definitions are not. One of those ways we can carve up a group is we can have a group be homogeneous or homogeneous. I've heard it pronounced different ways. I don't know which one's correct. The idea there, though, is that group is made up of individual organizations that are all doing the same thing. They're all in the same industry, where we're able to essentially more effectively share best practices amongst our group members. If we have claims that happen, we all likely have experience with that claim scenario because we're all doing the same things in our daily lives, okay? The heterogeneous option is the reverse of that. And that's where we say within this box, we want it to be diversified, as many numbers of industry, different types of industry as we possibly can, different locations around the country. The thinking there is, one, we'll have exposure to things that we don't necessarily see on a day-to-day basis. So when we have best practices that get shared amongst a heterogeneous group member, you may get to see a claim scenario that you likely would have never seen inside of your normal operating entity that will provide you some insight into how you can make changes for something in your industry that otherwise you wouldn't have been exposed to. As you're sharing risk, if you share risk with a bunch of group members that are all doing the same thing, if one one loss event happens that can impact the entire industry, that's a risk, right? So if you were all a bunch of developers or construction entities and another Chinese drywall situation occurred, everybody is going to be taking losses, and that puts the group at a significant significant risk of potential loss. Where if we had it spread out amongst contractors or professional service organizations, or the larger the risk gets spread, that same one event doesn't have the potential to impact the group as it does if everybody was doing the same things. So I hope that makes sense.
Yeah, so what I hear you saying is that the heterogeneous might be somewhat less risky, or that with the greater diversification?
It certainly can help. There's other component factors that go along with it. So like if I had, let's say we're all doing the same thing, but the group is made up of 1,000 members, that in and of its size may help offset any of the concern we'd have from the diversity of the trade. So it's not the only thing, but one of the most common decision-making factors that insureds will say when they go to enter into a group is it's just a conceptual one. It's, do I want to participate in risk with people that I know what they're doing, or I know what everybody else is doing here, and I'd like to go ahead and share risk with somebody else because that makes me feel more safe. It's a risk tolerance question. I hope that answers your question. Again, underneath the group captive structure, we are prescribing to something that already exists, so that if the group is set up to do comp, auto, and GL, that's all the group is going to do. If you wanted to do property or builder's risk or crime, and I'm just picking out things as an example, you as a member can cast your vote in order to make that change come to fruition. But if enough votes aren't passed, then you're kind of out, okay? Group captives operate off just like any other normal business with an amount of fixed cost, it costs to run the business, and then amount of essentially potential available for underwriting profit. Under a group captive structure, depends on how the group is structured, but there's normally going to be a fixed cost somewhere between 30 and 45%. So I know that for every dollar of premium I spend, about 30 to 45 cents of those dollars, I'm never going to see again. That's going to go and pay for some of the things I'll touch on in a second: captive managers, the regulator fees, the fees for the paper that we were talking about before that gives you that A or A plus rating. The rest of that premium, that which is now 55 or 70 cents on the dollar, that goes into what's called a loss fund. That's essentially your captive insurance company's share of a bank account. And that what is become it's where you pay for your claims. It's where you pay for your share of everybody else's claims. Because again, you're sharing risk in these scenarios. And then at the end of the day, which oftentimes ends up being somewhere between 3 and 5 years, it varies by the group, you get back a dividend, which is the difference between that loss fund amount you had, plus the claims you paid out, plus any investment income that you accrued over that time period. Now that money is going to come back to the shareholder of that insurance company. So whoever owns that share is then going to receive that income. Okay. Because we're doing this with a whole bunch of entities, though, we have the opportunity oftentimes to start into a captive from a threshold that's going to be lower than you do if you're doing this yourself. So group captives, if I'm going to say, am I a group captive candidate? If I, again, just general rule of thumb, using casualty as an example, have workers' compensation, auto, or general liability premiums of about $250,000, and I have good losses, so my loss ratio is somewhere under 60%, then I'm, generally speaking, going to be a good candidate for a group captive, right? I've got to have met the minimum premium thresholds. I'll have enough money left in my captive to pay for my expected claims, leave everybody with some underwriting profit, and it should be a better solution at the end of the day. If we move to a single parent captive, which is on the next slide, I'll kind of discuss the differences here. So the single parent, or what sometimes can be called a pure captive, no difference from the group other than the fact that you are the only shareholder. Okay, so instead of you essentially electing to join something that already exists, something gets formed specifically for you and your organization. Okay, you are not exposed to unrelated losses or third party losses. So those other folks in your group that may have something happen, you're not going to pay for their share of the claim. The reverse of that's true, though. So if something happens in your captive insurance company, unless we're buying reinsurance, you're going to elect to retain all of that risk yourself. Now, you do that because you have the potential for essentially greater underwriting profit. So fixed costs for a single parent captive can vary anywhere from 5 to 15%. Okay, so that means I've got 95 to 85 cents on every dollar that's going to go into that captive loss fund. Okay, I get that much money because I'm taking all of the risk myself. Now, I also need to have enough premium in order to stand up this transaction by myself, which is oftentimes where they can fall down compared to a group captive option. Because a group captive is going to have its 10, 20, 100 members paying their $250,000 of premium. That's going to be a big bucket. Captive carriers will have appetite. That works. On a single parent arrangement, you can't afford to do that at $250,000 of premium. We can't pay all of the expenses. We can't buy the paper that we need to evidence the insurance we need for that low dollar amount. So oftentimes for either single parent or new group captive, so if we go to start a new one, we need to have at least $1 million of premium. Okay, so you would be a larger organization in order to do a single parent captive, which is, again, you own the insurance company, you've posted all of the regulatory capital yourself, you posted the collateral, but then you have complete control over what happens. I can hire and fire my captive manager if my captive is in the state of Tennessee, which is where mine is today, and a law changes that makes it more favorable for me to move it to Utah. I can move my insurance company to Utah. I can choose when and if I want to have my dividend and distributions come out, who I want my investment manager to be. If I want to stop doing builder's risk and only do property, or add general liability, or do crime, or I'm in charge of the determination, assuming the regulators approve it, of what my captive insures or reinsures. But we have a higher threshold for entry. Okay, so again, we own the whole thing. We're in complete control, but we have to be larger than we otherwise would in a group, because the group you're sacrificing that control, limiting your potential return. but doing so because we're getting premium aggregation from everybody else for something that already exists. Hope that makes sense. And again, stop me and interrupt me if something doesn't. And then if this is the Goldilocks and the three bears, we had the mama bear, we had the papa bear, and now this is the one that's going to be just right, okay? For a lot of insurers. And that's going to be a cell captive, which is on the next slide for us. It's a confusing topic because different states and countries will call essentially the same concept something different. And there can be slight variations within the language, what it actually means. But essentially, under a cell structure, what happens is somebody forms an insurance company that acts as a mothership, okay, a sponsored facility. I own one myself. And underneath that facility, I have posted the capital, I've posted the regulatory required minimum fees. I've gone through the licensing process, and I've obtained a special kind of license that says I can hang individual captive insurance companies off of my license and let them use my capital. So instead of you forming a new insurance company, again, for just your own risk and needing to post at least $250,000 of capital, you could enter into a cell arrangement where you use my license as an example, but you need only capitalize your bank account with $25,000 as opposed to $250,000. Okay. These individual cell captives can be incorporated or protected or segregated. And there's, again, a bunch of different terms. What that boils down to is one of two things. Underneath my cell, are my assets and liabilities segregated from all of the other cells, or am I exposed to the losses of those other unrelated cells to me? Okay. Most insureds will use cell captives as an incubator. So they will say, I'm going to form a protected cell or an incorporated cell where I know I've got my own corporation. It's going to have its own tax return. Granted, I'm using somebody else's license, but I'm in control of this insurance company. It's mine. And if I have a loss, it's not going anywhere else. If anybody else has a loss, I'm not going to pay for unrelated losses. Right. So, and then what happens is over time, once the insurance, the captive gets enough money, many insureds will take it out of the cell structure, convert the license to a standard single parent captive at that point in time, and kind of move on and do their own thing. The trade-off for that lower capital is going to be some of the trade-off for control, okay? Because I own the sponsored cell facility, that means I've made the determination that it's in the state of Tennessee, who the insurance company manager is, who the tax and audit professional is, as an example. And those are things that the cells don't really have the ability to change, okay? They do have the ability to make determinations. Again, this is not specific to my facility, but cells in general, for dividend and distribution requests, or who you want your investment manager to be, or your third-party claims adjuster. So you get more flexibility than in the group space, less than if you owned it yourself. The trade-off is that from a premium threshold standpoint, it's about between the single parent captive and the group perspective, just to be able to fit in from a buy-in standpoint. And the controls about the same too. Yeah, we're going to get more money back. We have the opportunity to take more risk. It's going to be in my own insurance company. I'm not going to have to post a whole bunch of capital to the regulator to make this thing get off and running, but I'm going to do so knowing that that exists because I'm using somebody else's license, somebody else's capital, and you'll pay oftentimes a small seeding fee in order to make that happen. It's typically like $1,500 or something along those lines, but you give up some control. So I'll pause there and if there are any questions.
Is this more of a temporary position while a firm is sort of growing, or could this be a more permanent structure?
Either or. So most insureds will end up in a cell and will just stay there for forever. Because under an incorporated cell structure, as an example, they have their own corporation, even though it's using my license, again, just using my facility as an example. If for some reason they really wanted to go to Utah and I didn't want them to, the captive has its own corporation. We can carve it out of under my umbrella. They can move that over to Utah without having to start all over. Okay. So the corporation moves itself. Many businesses, though, they never have that issue. It doesn't have anything to do with my facility or otherwise. They say, you know what, the cell's working for me. I really don't care about the other things. It's not important enough to make the change. But if it is, they can absolutely have that ability. I hope that makes sense. Yep. Excellent. So let's keep moving on here. We've got about 5 minutes left. I want to touch on the service providers that we have, which I have it as slide 17. And then kind of the process for how you would evaluate to see whether or not a captive is good for you. Excellent. So again, I've touched on this a couple of times. The captive insurance companies are licensed regulated entities by state or some financial conduct authority. So Bermuda or the Cayman Monetary Authority, the Cayman Island Monetary Authority, in London or Lloyd's, it's financial services conduct. So there is a regulator that's involved for your captive insurance company. Regulators will require that you have a captive manager. A captive manager, think of them as the facilitator between the back office between your insurance company and the regulatory body. They will do your financial records. They'll do all of the filings, act as kind of a TPA for a 401k for your insurance company. So you can continue doing what you do in your day-to-day business. They run the insurance company for you. And then you have to have actuaries, that tax and audit returns. You're going to have some money coming back into the captive. The ultimate tax treatment aside, you should be targeting some kind of rate of return in that portfolio. So you get to select your investment manager. The money's got to go somewhere. So it'll be in some kind of trust or bank account. If claims happen, claim adjusters still get hired in the same way that they do today. And in the event where we have that need for rated paper, and again, if we're talking for property needs inside of your industry, there's almost 100% certainty going to be the case. You're going to have that. We'll have fronting or reinsurance carriers. And those are, again, the carriers that allow us to provide the policy that satisfies your lender requirements. And then they reinsure the risk to your captive, where you get to retain all of the underwriting profit. Again, the difference between the premiums you take in and the claims and expenses you pay out. Let's move to the next slide for viability. Let's kind of talk through the typical path for what insureds are going to walk through when they decide if this is something that makes sense for them or not. And again, apologies for whatever happened here for the formatting. I'll get this PDF'd and so we can distribute it out after the fact. So first and foremost, a captive insurance company as a separate corporation is not something that we should just be making a decision on for a short-term one-year policy. Again, it's a licensed regulated entity. We should be looking at this from at least a 5-year time horizon. I talked quite a bit about the potential to receive underwriting profit back into your captive. So if we have good years that happen, we're going to retain that difference in the premium, again, for what we received and what we paid out. But you get that opportunity because you're taking on risk, which is required inside of an insurance transaction for a whole host of reasons. So you need to make the determination as a business owner and potential owner or participant in a captive. Do I want to do this? Am I willing to take on that risk? And do I think that my previous performance is because I am good or I am lucky, right? Are we willing to essentially bet on ourselves? And if we are, then again, we're going to own the insurance company. We'll finally be able to get back an ROI if things go as projected for all of the investments we've made over the years to help reduce our costs of loss in hopes of getting a flat renewal, which you're never going to get in the near future. I hope I'm not the one that's going to break that news to you. But what you don't know is once we get past the conceptual, do I want to take risk? Am I comfortable with captive concepts? How do the numbers work? Okay. So typically what happens is insurers will engage the services of their property and casualty or life and health insurance broker, whichever the one is going to be, because they are required in the transaction to provide you coverage, advice, service the account, so on and so forth. And they say, I think I want to look at a captive. Can you help me? Good news, bad news is that brokers have oftentimes heard of the concept of captive. Bad news, it is a very specialized portion of the industry. So unless you have a very large insurance agency that you're working with from a brokerage perspective, and even some of the largest ones will outsource that subject matter expertise to third parties like my firm and others. Okay. So what ends up happening is you say, I want to look at a captive. Broker reaches out to either someone like me or a resource internally, and we provide essentially estimated numbers. We say, all right, if this is what you've got, this is what your losses were, this is how much the premium would be, this is what any collateral or capital obligation would be, and this is how much would be left over. The question then goes back to you all as the potential new captive owner. Is that enough to move the needle? Is the juice worth the squeeze? Or for whatever reason, is a captive scenario not going to be right for you? This extends to potential tax complications that you may have with not-for-profit entities. We don't want to inadvertently have a for-profit captive essentially owned by a not-for-profit entity. and have some unintended tax consequences, right? So it's a part of the process we walk through how we handle the potential tax liabilities there. But essentially, at the end of this viability process, you know whether or not this is something that's going to work well for you. Then licensure is the next slide for us. And this is where you say, let's actually take the formal step to do something about this. So I've given my broker the direction to bind the coverage from whoever the carrier or program is. Now my captive manager that I've selected has prepared a feasibility study, a business plan. I've given them biographical information, essentially the information that the regulator is going to need in order to give your captive the license. That gets submitted to the regulator for their review. Once approved, the regulator will say, put your money into a captive's bank account. Again, that's where either the statutory minimum capital comes in or the cell capital comes in, or in a group captive arrangement, that's where you pay your share of stock to enter into the group. And you pay the premiums, and then the money gets divvied up. Money goes to the fixed expenses, money goes to your loss fund. Claims that occur throughout the policy period, regardless of the structure, are taken out of that loss fund. And then at the end of that policy period, or whenever the group essentially elects to return dividends, if you had positive performance, that's where you get back the money for, again, the underwriting profit you've had over the past, as well as the investment income you earned over that time period. And then last but not least, quickly, is we have some obligations on an annual basis. Again, this is regardless of who the insurance company is, group captive, single parent, cell, or otherwise. If we look at the next slide, the captive is going to have some corporate and regulatory requirements. They're typical things. The captive needs to have an annual meeting. Whether or not that meeting can be done virtually inside of the United States or it has to be done offshore depends upon where you form the captive and whether or not it's a group captive or a single parent or cell captive. Regulators will then look at the filings every year. They'll look at the financials. You'll pay your taxes every year. You'll have an audit done. And then as your business plan may change for the captive insurance company, you file business plan updates to your insurance company on an annual basis or as needed. Again, most of that work is being done by the captive manager. Your obligation as a shareholder of the insurance company is going to be limited to mostly the corporate meetings and the review of your performance throughout the year, regardless of the captive structure. Again, the idea here is that we're going to own either whole or in part a captive insurance company or a share of a captive insurance company. The idea is that however that's structured, whether we're sharing risk with others or not, we get to retain the risk, we get to retain the premium we want. And if we go through years as expected, our business gets to benefit from the difference as a potential dividend down the road, and top of some other things, right? So you'll get premium stability, you'll get control over claims, we can have independent third-party panel counsel, a whole bunch of other stuff we don't have time to touch on today, and it's kind of a 201 conversation, if you will. Just know that, again, captive insurance companies are used by folks that are tired of the roller coaster of the standard insurance market. They are of a size where financially and from a risk tolerance perspective, they say, I'd like to do something about this and I'd like to own my own risk, whether or not that is by joining a group captive, having a group captive formed with other new members, or stepping out and taking on some of that risk yourself. You're essentially saying, by formally taking this risk, you're going to give me back a bunch of the premium and I get to keep it, again, either as a sole owner or a shareholder owner of a larger group captive. Can't beat them, join them, right? It's really the only meaningful way that you all as insureds have to combat essentially the roller coaster of the insurance market, because all of the other tools you have are largely going to be limited by those lenders, where you have to have certain paper, you have to have max deductibles, you have to have coverages of at least X, Y, and Z. It really ties your hands. This frees them up as best as you can. I hope that makes a lot of sense. That brings us to the end of the presentation. Apologies for going a couple minutes over here, but we had some good questions during the interim. I'm happy to answer any others that may exist now.
Awesome. Thank you so much, Nate. That was very helpful from my perspective of having no knowledge of this. Definitely good to get a foundation. Want to go ahead and open it up to questions. Anyone have any questions for Nate? And then we can also hear a little bit from the practitioner's perspective from Ari, why TM made the decision to go this route, any pros, cons, challenges.
Could I ask you a couple of questions, Susan?
Of course.
John Spencer. Yeah, first of all, Our annual renewal right now is September. I mean, how far in advance of a renewal should you be looking at this? This seems pretty complicated. That's one question. And I guess getting through this process, if again, we're a relatively small company, five properties, 800 units, not 250,000, more than that, but not a million. And would we be looking at, to bring in somebody like you to kind of evaluate our situation and give us some suggestions?
So I'll take those questions, hopefully remembering all of them, right? So one is, there is a lot of information here, so don't get me wrong. And what we're doing now is we're taking the first bite as opposed to trying to swallow the elephant whole, okay? So the good news is that although these captive arrangements will take some time in order to go ahead and underwrite, it shouldn't take any more time than your normal renewal takes. So my firm, as an example, I want to see submissions in from our broker partners about 90 days before your renewal. That's when your broker is normally going to start to work on your renewal anyways. During that process, this is not unique to my firm. Whoever the consultant or the underwriter is on the captive side will be running through the captive process with you, educating you on how the captive works, the structure, potential options, while the broker is still doing the standard marketing through the commercial market as you would today. That way, again, during this process, from a captive perspective, from my firm anyways, I want to be able to get you to know as soon as possible. If the answer is no, I'll tell you why it's not going to work now. You're going to tell me why it's not going to work. But if we think it's got some legs, we're going to have enough information that we'll be comfortable saying, you know what, higher likelihood than not, this makes sense for us, okay? So that's, again, 90 days, and that's kind of the process for the education up until binding. Did I miss another question that you tossed in there? I think you may have muted yourself, sir.
I did have one more question. I'm not sure it really goes to you. Maybe goes to Brendan if he's still on the phone, or maybe Ari. We're not part of HPN, so how do you go about joining one of those groups if you're not in that group, or not perhaps our properties aren't managed by TM at this point. So is there a way to seek out a group if we don't meet those qualifications?
Yeah, that's
or
a good
maybe
question.
they allow third parties. I don't know.
It's a good question, and I won't speak directly to HPN. I'll let him address this in just a second. But largely for any group, you would ask the broker, essentially find me some groups that are out there, and they're going to be known to the broker, or they'll ask somebody like me about groups that exist. If they exist, we'll give them that information. If you're of a size where you may be, again, somewhere in that Goldilocks zone, am I too big? Am I too small? Could I do it by myself? It's a cell as an example, as opposed to a group member. That consultant that they ask will also provide them some guidance and say, all right, chase down the group, but we can also chase down this cell one because, again, it's your money in this instance. Figure out how it works. Whether the qualifications for entry and participation into the group will fall to the group itself. So if some individual wants from HPN wants to address that now, or maybe offline, you're
Okay.
Yeah, I can address quickly and specifically to your question of HPN. The first underwriting criteria to be part of the HYPEX group captive is to be a member of HPN. So that's the first step you'd have to go through. So you'd have to go through the application process with Housing Partnership Network. And I just want to point out one thing that you said at the end, Nate, that I thought was really important that you said, because I've received a lot of inquiries into joining HYPEX, and that have you been good or lucky with your loss experience is so important. And joining a captive or any other risk transfer mechanism for your insurance, having a thorough risk management program is super important. You can't outrun your claims.
Yeah, that's right. Just to touch on that, so it's more difficult of a decision to make from a property perspective. And again, I don't act as your broker, so I'm not giving anybody coverage advice, but just the nature of property risk. There's a higher likelihood that something happens that we have absolutely no control over. So that could be a lightning strike, it could be a flood, a hail event, and we know if we're taking that risk on in our captive, we're going to be paying some share of it. Okay. Our ability to mitigate that claim is largely going to be like if we have an in-house development or construction arm, or we have remediation or restoration contractors that we would like to use because they do a much better job, much faster, much cheaper, right? That's where we mitigate those claims. Most folks from a risk tolerance perspective and a predictability piece will end up looking something at the general liability because you've got more impact to be able to have on the claims there, right? So there we can essentially direct independent counsel for, we believe this claim to be fraudulent. We want to fight this thing tooth and nail. I'm glad to spend $5,000 of legal fees as opposed to what the standard market does is, oh, slip, trip, and fall, put a claim. Now here's $30,000. We just paid it out, and you didn't find out about it until 90 days later, something along those lines, right? We also have caps on the risk that you would retain that's often less than in property. So if you've got cat exposed properties or things that are hurricane exposed, you may need to take a couple $1 million of risk in order for that to work. Where under a general liability policy, if it's a normal 1 million, 2 million aggregate, even if you took back all of the risk, you know that your max is only $2 million, right? So there's just a cap. There's things to think through as you try and determine whether or not this makes sense for you and where it may make sense for you inside of your own insurance program. It doesn't have to be an all or nothing thing.
Yeah, I mean, John, I mean, yes, I mean, to Nate's point, you know, we have to have financial interests. So, you know, we either have to be an owner in our captive or we have to manage the property, and, you know, property managing someone else's property provides us financial interests, which still means it comes out of our pocket in the end, which means we're concentrating on all those things. To Brendan's point, good versus lucky. We can be as good as we want to be all day long. Your luck runs out at some point. It's just the odds. And, you know, I know a lot of us talk about, you know, weather and everything else and how it's changing. One of our members, you know, has a bunch of deals in Kentucky. Well, guess what? Kentucky is now a tornado state where it never used to be. And a few years ago, remember when those towns got completely wiped out? Well, he had a large two-phase deal in one of those towns and was left with nothing but the concrete pads the property was built on. Massive claim, nothing that, you know, him as a standalone captive would ever have been able to absorb. So being part of a larger group, you know, we can all say it's never going to happen to me. It's never, he would have said the same thing. It happened to him. You know, so, you know, it also puts new rules into place for us. Now that there's new wind zones for us, you know, there's now more picking and choosing as to what's acceptable to be part of our captive. You know, he comes by and decides he wants to build a third phase in that town. Of course, the captive goes, nope, we're taking the first two as we have before. The third one, you got to place with someone else. It's too much of a risk. We've seen it. It's happened. You know, at some point it's going to happen again.
Sorry, with that, maybe I'll turn it over to you and you want to kind of share your story, talk about the captive that you're in, your experience, maybe differentiate again the type of captive you're in compared to the ones I talked about before, because there are some variations, and see where it takes us.
Our captive's been around since 1986. It was formed back then because of a hard and difficult insurance market like we're having now. Of course, what they experienced back then is a little different than some of the new fun things we have now. But yeah, they were fed up of increasing rates and everything else and thought, you know, if they could take more control over it all, you know, it would be to their benefit. And if they can make a profit on the side, that's great too. We are fully for profit. We are based in Bermuda because back then, international tax law was different. And so all the money that the captive made was sitting resident in a Bermuda corporation, which means it was not taxable in the US. So the Bermuda corporation could still send its money and go invest in the US stock market and make a profit there. And all those earnings were still tax deferred until the one day you repatriate your money back to the US. So, you know, the world of compounding financial, you know, worked great for the captive over the decades of, you know, being able to earn money and not have to pay taxes on it and just keep reinvesting it. Which has built up a very nice nest egg. And, you know, we could probably insure, you know, 10 times the amount of units we currently insure based on the regulatory environment, but we don't. You know, we keep it to what we own and what we third party manage. You know, we've gone down the rabbit hole of nonprofits who want to join our group, and, you know, the accountants and tax people, as Nate said, say, nope, additional tax consequences there. So, you know, we've had to turn those people away. You know, we have a lot of brokers who come to, our captive all the time who do not understand captives even remotely as to what they do. They want us to provide insurance for their properties, and the answer is no. It's not, we're not a regular insurance company. It's for our owners, not for everyone else. And that's always been a big key thing in your risk management, because we're always keeping our eyes on it all. It's given us the flexibility to choose our, everything from our deductibles, which we can dictate across the board. And we do vary from property to property. We can shift burdens across the portfolio. We also have the ability for projects in wind zones along the coast that have large wind deductibles. We have to go out and buy a separate buy down policy for those. But by being part of the captive and it's all grouped into one, nothing that anyone ever sees, those additional policy premiums I can now put across our portfolio. And, no one cares that it's an extra $1 a unit across everything as opposed to a single project where all of a sudden you're going, oh my God, I can never afford that insurance. It's too much. It's never going to happen. So we can balance everything across our portfolio, and, it just becomes a rounding error in the scheme of things. But, I mean, we're also, have, I think 30 other affordable developers in our group. We do not do urban. Chubb is our insurance company. They're also very picky as to where we do business. Places like Florida are not even remotely on the table. I don't think Nate's captives would even touch Florida either.
We do actually. So again, that's one of the differences between a group captive structure and the single parent structure, where he's defined his box, and Chubb has helped him define this box in this instance of saying what good looks like and what risk is we're acceptable or willing to take on. Underneath single parent captive structures, that box is often defined by the owner of the insurance company. Now, my carrier partner has to agree to it. The good news is in these instances, I'm one and the same, right? So I'm speaking on behalf of the carrier, so I can tell you whether it's going to work or not. The choice comes down to whether or not, again, the owner of the insurance company, the insured business, is willing to accept that greater risk and has the financial wherewithal to withstand a hurricane event. Because we can't pick up and move our buildings out of the path of a hurricane. We need to know that in that event happens, or a wildfire, again, we've done as best we can in order to mitigate our potential for loss, and we'd like to take on that risk. If our clients say we've got the money and the tolerance to do so, have at it. Groups get to make that decision for themselves, just like individual captives get to make the decision for themselves as well.
Yeah. But, as Nate said, Chubb does dictate some of those things. Our portfolio now has over $100 million worth of real estate in Ashburn, Virginia. And Chubb has now told us that we are at $100 million. We're now at their limit for that area of the market. So anything, our next project that we build is not eligible to be part of the captive, because they're looking for, in case the hurricane comes through, most likely all of Ashburn is, getting hit, so every single one of our places would get hit, and that's too much of a risk. And, I understand it's, you start doing the math and it feels like too much of a risk yourself when you do it. So you also got to be very cognizant as to what your footprint is. When we look to add new members to, our captive, we're always cognizant of our footprints and, where is the captive not insuring anything, and what states and areas do we actually want to be part of that may help spread that risk around. So, our captive managers go out and go, hey, do you know anyone in the industry in, states A, B, C, and D? We need to keep growing. We need to spread the risk around, and we want to find places where, we're not overlapping and double down on our footprints to spread that risk. So, we all go look up and call our friends and, hey, you interested in joining? What's your insurance rates? This is what I'm paying. Some people are game for it. Some people are very hesitant and nervous. Change, is always, difficult especially when you don't understand it. I mean, it can take 2 to 3 years for us to bring on a new member, because everyone gets a sane vote, and, do I know them? You know, what kind of product are they building? You know, is this someone, you know, what's their reputation like? You know, has anyone done homework as to, you know, what's their risk management policies? You know, we look at our risk management policies extremely careful. You know, as we've structured it with Chubb, us personally for our portfolio, we are responsible for the first $150,000 of loss. And then the group share is in the second $150,000. So Chubb doesn't even kick in until after we've broken $300,000 on a claim. You know, just because I don't have a lot of claims of, you know, 10 million, 20 million, whatever, you can also die the death of 1,000 cuts. You know, you may not think too much of the $5,000, $10,000 claims, but, you know, they add up and they, you know, dig in and absorb your premiums quicker than you think. So we are constantly out there looking. We get weekly reports on what claims are going through. We do an annual evaluation. What, you know, what am I getting hit by? You know, a long time ago, you know, our captive had a lot of issues with stovetop fires. They were huge. And, you know, it's very easy for it all to add up. And, you know, it doesn't hit Chubb just because, you know, that 10, 15, $20,000, maybe 30,000, Chubb never sees it, you know, but they're going to approve it right away out of our account, especially if we're asking for it. So, you know, we've had to make adjustments and, you know, there's a mandatory requirement that, you know, now everything either has to have range queens above in the hood, or you got to have one of those stoves that, you know, limit things. I know as Hope on here can attest, you know, that's been a big thing for Virginia housing. It's a requirement for a lot of us out there, especially for the new rules coming up. You know, once we've put that across everyone in our portfolio, I mean, the amount of losses from kitchen fires has gone down greatly. Heck, you know, some burning on the top of a stove, some black soot on the wall. Hey, that's easy to clean up. You know, no one needs a claim for that because you haven't, you know, burned out the kitchen. You know, our new thing, which Beverly is dealing with, you know, due to the age of our properties, water leaks, hot water heaters that are now, you know, past their age or leaking and exploding. So once again, we're sitting down going, okay, how old are all the hot water heaters? And do I need a plan to make sure that, all right, the life is 7 years. I need to make sure I'm replacing it every 7 years, whether I like it or not, because it's hitting us left and right. So those are, you know, things that
Let me interject if I could for just a second. So what Ari is mentioning now is a critically important thing, but it's one that's not obviously obvious, and not obviously obvious as though redundant. It's not typically obvious during the early decision-making or due diligence phase of a client looking to explore a captive. And that is at some point in time, and it's normally after the captive gets formed or they join the captive, the light bulb actually finally turns on where I said, you know what? I actually do own an insurance company. Either I own it or I own a share of the company. I have my own risk. And now you as the business owner are not necessarily thinking in the same mindset as an insurance just purchaser in the standard market as you do when you own the insurance company. Because at this point now, we're talking about water heaters or smoke detectors and those kinds of things. Are you going to change them? Maybe, but you'll change them like when it actually gets to the point in time where you really don't have any choice. Knowing that in the standard market, if something happens, you'll pay your deductible and the standard market's going to go ahead and pay the claim and we can move on with our lives. As an owner of an insurance company, you got to view that a little bit differently because yeah, if the loss happens as my insured business, sure, I'm still going to pay a deductible if one's applicable, but then the next dollar amount I pay for that claim could be all of it is now going to come out of my insurance company or my share of that insurance company. So there's actual incentive to do things proactively as opposed to reactive, which is what happens in the standard market, because good proactive management here ends up being a better net result for you because you get to keep more of that premium. Again, you're starting to think as an insurance company owner as opposed to just a buyer of insurance in the traditional market. I hope that makes sense. Sorry for interrupting.
No. You know, and as part of that, you know, I mean, we're with a bunch of like-minded other owner developer managers and, you know, there's constantly emails and discussions going out. Hey, does anyone else have this problem? What are other people doing? You know, we're all in the same boat. We're all looking to, you know, lift our boats up with the rising tide, and, you know, we're constantly asking each other, you know, what are you doing? You know, I can tell you how many other losses they all have across, you know, their groups too. You know, we spend a whole, you know, many hours each year discussing it all as a group. And we also do it individually on our individual portfolios. And for those bad years that we've let some things go that we shouldn't have, you know, there's other members who, you know, pick up the phone and go, dude, you're killing the captive here, you know, I need you to step it up. And, you know, and sometimes that encouragement really helps. And, you know, and I mean, we're all friends, partners. We've been, most of those guys, they've all been together, you know, 10, 15, 20, 30 years. So no one's ever afraid to pick up the phone and say, hey, you know, do you need some help from me? What do we need to do to put you back on a better footing? Because, you know, I'm absorbing your losses because you're crossing over the 150,000 threshold. But, you know, I never worry because at some point it's going to flip back. The odds are it's going to flip back. You know, we absorbed so many other partners' losses for a long time. And now, you know, we're in the other direction. You know, we've acquired a lot of projects that are old and they have their issues, and, you know, people are paying for our losses now.
I'm going to kind of interject and kind of go just a little different direction to everyone, whether you have a master policy, single policies, or you're part of a captive, you should be utilizing risk management techniques. You should be watching your portfolio and figure out how to reduce your risk and the number of claims. Because before joining TM, I came from the nonprofit. I had a master policy, no captive. We weren't big enough, we weren't a member of HPN. And my broker would actually go out and push my insurance companies to keep my premiums down because we managed our risk. And he could say, well, you can't, you know, this is how much they've had in claims, and this is how much they've paid you in premiums, and really fight to get my premiums down or kept under control. So risk management is really important, regardless of what kind of insurance or how you insure. I'm sorry, I'll shut up, Ari.
No, it's all good, Beverly. You know, by also having a captive, we've been able to, you know, alter some of our policies, and, you know, by how well we've done, you know, we've also added, you know, some tax credit insurance, you know, for nothing, you know. So when Beverly goes, oh crap, someone's Christmas tree on Christmas Day burned down and there's no way that unit's getting back up online by 12/31, it's okay. We have tax credit insurance covered as part of our captive. So, you know, you got 6 months to get that unit back up and running. You know, insurance will cover it. So that's, you know, it's one of those things. And we have people who, you know, have us manage, and they're always like, thank God you have that insurance, because that would have cost me out of pocket so much money. Yeah, yes, we're taking on that risk for them, but, you know, that's part of us managing and willing to take that risk for insurance. You know, but, you know, you also have to be cognizant of what your footprints are and what everyone else's footprints are. You know, some of the big costs we have out there is what we call social inflation. You know, that can hit you hard. I mean, we had a member many years ago, drive-by shooting at the property next door. You know, one of the random bullets went through his building and killed somebody. He still got sued for not protecting his residents for a drive-by shooting at someone else's property. Still cost him a ton of money. I mean, those costs keep going up more and more. And it can also vary greatly depending on which state you are in. I mean, for a while, New York was known for their nuclear verdicts, you know, that just go sky high.
Thank you, Ari. I know we have just a minute left. Anyone have one final pressing question before we want to let everybody go? I know we've taken a lot of your time today, but it's much appreciated. Everyone feel good? I know this, like Nate said, very 101. There's definitely more to all of this. And for all of you wanting to get started on the process or thinking about getting started on the process, we'll send out slides so that you can review them, as well as a recording of this session. So I know some of you said you're covering for coworkers who are out. If you have follow-up questions, feel free to send them to myself. I can field them to Nate, or if Nate's comfortable dropping his contact info, and then Ari as well, if you are open to taking questions as well. Otherwise, Han can field those and get you guys any answers you need, whether that's from them or if we need to find some other resources for you all, we're more than happy to do that as well. But I want to thank Nate and Ari for taking the time to present and share their perspectives with you all. It's been super helpful for me, so I hope it was for all of you as well. But if we don't have any other questions, just want to thank you all again for taking the time today and give you a heads up. HIT 4.0, the housing indicator tool, which is HAN's policy and advocacy tool that tracks housing production in the region. The 4th installation of that is launching on March 21st. So be sure to check out the calendar and RSVP for that. It's happening in person for the first time ever. So we hope to see all of you there. But again, thanks everybody. And I hope you have a great rest of the day.
Thank you.
Thank you.
Thank you.